Hello and welcome to the Property Playbook. Each week, we tackle the headaches that keep landlords up at night and uncover the strategies and plays that help property owners succeed. We bring the subject matter experts to you for quick, information-packed episodes. I'm your host with the most... Who put that there? I am your host, Peter Carlseen, California broker in sunny San Diego, helping clients with their real estate and property management since 2004. Today, I'm joined with Cristen Carver at Barrett Financial.
Hello.
Great to have you on, Cristen.
No, it's great to be on.
Excellent. So we're going to talk a little bit today about some of the products that landlords and investors might be interested in.
Okay.
But first, I'd like to hear about what your experience is in the industry.
40 years in the industry, mortgage banking, San Diego, born and raised.
Nice.
So
very good. What kind of products would you recommend for investors that either want to buy investment property or that maybe already have some that need to leverage some of those that equity?
Well, there are a lot of products. There's still the regular A-plus product stuff we're doing through Fannie and Freddie, 20% down for a house, 25% down for other units and stuff. 3 to 4 units. So we're still doing a lot of that. We're doing more of the government stuff. I think we talked about that before, the FHA and the VA.
Yes.
Where you can purchase up to 4 units, FHA or VA. You do have to purchase owner occupied.
Yes.
And then rent out the other. So that's an excellent way to buy your first investment property, right?
Yeah. So just to clarify on that. So if you're buying a 4 units on a property, you're only living in one of them.
Right.
And you're renting out the other 3. Those other 3 rentals can count to your DTI?
Yes. Yeah.
Okay.
And it's a little bit, so VA, easy peasy. 4 units, 75% of the rent counts. On FHA, 2 units, 3.5% down. Same thing. They'll use the rent on the second unit. But when you get into the 3 and the 4 units, the mortgage payment cannot be more than the 75% of the gross rent on all the units. It's called a self-sufficient test.
Okay.
So it's like a little bit different than VA, a little bit tougher to qualify, but still you can get in pretty cheap.
Excellent. So someone's first time buyer or their VA, they want to come in, get some investment property, but also have a place to stay. Mm-hmm. That could be a great opportunity.
Absolutely. When you're getting into the units, FHA, you got to have some reserves, but VA, not necessarily.
Okay.
Case by case, depending on the qualifying.
Okay.
So,
VA is a little bit more lenient than in the guidelines.
Yep. If you have really good credit, you have, good job, stability, all that stuff, a lot easier. So.
Excellent. All right. And are rates similar to normal rates on those types of products, or is there a little bit of a premium on those?
There's no premium. On FHA and VA, it's the same interest rate, whether you're buying it, the 1 unit owner occupied or the 4, it's the same. You're going to see rates like mid-5s, 5.5%. It's crazy good. Now, not for the conventional stuff.
Sure.
The conventional stuff sitting owner occupied around 6, it's probably close to like 6.5.
Yeah.
So a little more expensive on that for sure. And then we have all the alternate stuff for the people that do not qualify traditionally with pay stubs or tax returns. We can do all of the other alternate investment products.
Okay. Now I hear alternate and my mind goes back to 2007, 8, where you had the ninja loans and no income, no job, no assets.
Yep.
You fog up a mirror, you can qualify. And if you don't, there's
Those
still
are good times.
The negative AM.
Yeah.
What are these alternatives that you're talking about?
Okay. So funny, we do have a true no income qualifier, like nothing on the application based on your credit and your assets. And that's like 75% financing. It's not that bad though. We're looking at rates like 8.5%.
Okay.
Yeah, that's pretty good. On the DSCR program, the debt service program, we're doing those. The property has to, kind of like the FHA, the mortgage payment and the rent have to be equal or a little bit more income. You're making a little bit of income. You can't be upside down, really. Sure. So those, you can still do pretty good.
Okay. And we talk about upside down. You're talking about like on the monthly cash flow.
Yes.
Your income has to exceed whatever the rent or whatever the mortgage payment would.
Yeah. There are some cases where it doesn't have to, where they'll go lower, but the more, what do I say? However more difficult it is, like there's way more mortgage than there is rent, then you have to put more money down or you have to have better credit. So if it's a really, really nice cash flow property, gosh, I can't speak. If it's a really nice cash flow property, then you can get in like 10% down, no problem. But on a property that's a little bit tougher to cash flow, then it gets a little trickier.
Okay. And what do those rate premiums look like?
Case by case, could be as low as like 6 3/4, could be like 9 3/4.
Oh, okay.
I mean, it's all over the place. It's going to depend on the credit, the down payment, the cash flow of the property. Huge. Number one thing.
Okay.
What is the debt service at?
Got it. Okay, so the better it looks, the easier it is, the lower the rate.
Yeah, and it's it's difficult in San Diego.
Speaking of that, I know you do loans in other areas.
Every single state except New York.
Every single state except New York.
Yeah, so much easier to buy a home in Ohio.
Yeah, but look at the weather there right now.
You don't have to live in it.
That's true. So where do you see people leaving San Diego? Where are they buying instead?
That's funny because originally we were seeing a lot of Arizona. We were seeing a lot of Boise. Boise was hot for a while, yeah. And Tennessee. We're still getting Texas, but East Coast. I'm doing a ton of Georgia, North Carolina, South Carolina. Yeah.
Interesting.
Mm-hmm. There's some rumors in Savannah. They're going to redo the port, and it's going to become the biggest international port. So hearing that people are buying investment property, they're thinking that it's going to blow up.
A lot of speculation there.
Yeah.
Interesting.
And I actually had a whole brokerage move there from San Diego.
Wow.
All the agents went there, bought property. Yeah. So I know, changing.
Give it a few years and see if that was a good decision or not.
Right?
Okay.
Like Vegas.
Like Vegas, yeah. All on red. So what are some of the, I guess, the obstacles that investors are facing when it comes to qualifying? Is it mostly just income, credit score? Are there any kind of weird other variables that they have to look at or look for?
If they're going A paper, it's full qualifying. So we're looking at them, we're looking at the property. But if they're doing the alternate stuff, then it's just the property. So it's not that hard to qualify. If you have the credit score and you have the down payment, you're good.
Okay.
So it's pretty easy to qualify.
Interesting.
Mm-hmm. And we can do all that crazy bank statement loan stuff now where you qualify off 12 months or 24 months bank statements, self-employed deposits as opposed to tax returns. We have programs where you can qualify off a 1099 income.
Okay.
In lieu of tax returns. Yeah, there's a lot of alternate stuff. I just did one for someone that qualified off rental income, but not on their tax returns. Rental income deposits in their bank statements.
Interesting.
Yeah.
So there's options there. So if you're somebody that's got a lot of properties in your portfolio, or maybe you own multiple businesses, or your taxes are just a bit more complicated than normal people, then there's probably a program that may be beneficial. For that.
The rates are higher, but we can get you in.
Okay. Sounds good. Want to switch gears here a little bit. I know the market here in San Diego has been a little bit cool lately. Why aren't people buying as much?
You can probably answer that better than I can, but I think it's because they are still waiting on rates. I really think they're so spoiled from 20 and 21 with those rates in the 2s and the 3s that they don't really understand that a rate at 6.5% is a great rate, for us that have been around a really long time. And we know that that's historically the average rate in the United States.
Sure.
They're just spoiled. However, and I'm sure you've heard this, there's never been more equity in the United States in real estate than there is at this moment.
Yes.
So people that are in, say, a condominium and they want to move into a home, or even people that want to downsize, they're sitting on that interest rate. And if the conventional rates can dip low enough into the 5s, it will trigger people to sell and buy. That's what we've heard. I don't know if that's going to happen, but we're right there. I mean, conventional rates sitting around
close,
6.
Yeah.
So we get a couple more, prime rate reductions by the Fed, hopefully, fingers crossed. Then maybe we'll see that and we'll see some movement.
Okay. So the movement that may unlock some of that equity, people moving up, moving down.
Yeah. More inventory.
More inventory. Because we just
inventory.
don't see that right now in today's market.
Yeah. So, and then I think the buyers will come out of the woodworks.
Okay.
Yeah. But it is hard to buy in San Diego. It's expensive, right?
Sure. Yeah, it is. It really is. I mean, even for someone to go from renting, say, a condo out here in Eastlake for, let's say it's not super expensive, $3,000 a month. If they were to buy that same property, their mortgage is probably close to double that.
Exactly.
Unless they put a substantial amount down.
Yeah, I'm thinking they're buying a mobile home. But yeah, exactly.
Interesting. Do you see a lot of mobile home investments?
Oh, yeah.
Interesting. Like whole parks or just individual units?
Yeah, well, you know what's, we do lend on those too. We do lend on mobile homes. We didn't used to lend on lease land, but we do now. So we do see that. But however, there's quite a few parks in San Diego where you own the land. You know, they're condominium-wise.
Really?
Yeah, there's some in East County. There's some up in North County. There's actually a neighborhood in Carlsbad that I think has like 18 or 20 units for sale right now, and they're anywhere from like 300 to 600,000. HOA is like 400 to 600 depending on the unit.
Okay.
And you can get in pretty cheap. So owning the land, you know, it's still a mobile home or a manufactured home.
Sure.
But now you own the land. So
you don't have to deal with space rent or...
It's so much cheaper.
Interesting.
So seeing a lot more of that, I would say probably a large percentage of those are senior homes.
Okay.
You know, senior parks.
55 plus?
Yeah, senior neighborhoods. Yep.
Okay.
And you know, the other thing is we're getting a lot more reverse mortgage stuff popping up now too, probably because of all the equity in the homes. So I'm doing a lot more reverse mortgages than we used to do.
Yeah, because people don't want to move if they don't have to. Mm-hmm. And I would think that the reverse mortgage really gives them that opportunity to have that cash, enjoy the lifestyle while not having to move into some place in Arizona. Or, you know.
Nothing wrong with Arizona. You know what I think too? It's just so expensive. Gas is expensive, food is expensive. And when you're living off your Social Security or your retirement and you're struggling and you can stay in your home and get the income to live on and be able to afford to live there until you die.
Sure.
Yeah, absolutely. But we're also seeing it on properties that have like trusts where the kids have inherited the home, but the kids are like 65 and they've inherited the home, their parents died. And so now they're refinancing into reverse mortgages. Wow. Yeah, they cannot afford to buy a home, but they can afford to stay in the home they just inherited and refi. So I've been getting some of those from those trust attorneys.
Interesting.
Yeah. There's a lot of product.
Okay.
You know?
So it's more than just the standard, 10, 20% down conventional. There's a lot of kind of tools out there that people can take advantage of on the lending side.
I think actually, I have 4 kids. I think one of my kids just said to me the other day, don't you have to have 20% down? And I'm like, wow, you should know.
One of your own kids.
Yeah, that they should know. You're obviously not listening to me on the phone. But you can buy a house with like 3.5%, 5%, whatever, military zero down. I mean, you can get in cheap. And then we have all the down payment assistance money and nobody uses it anymore. I mean, it does not run out. In the old days, we'd get it, it'd be gone in like 3 months. They don't run out. Is
it because there's fewer first-time buyers actually able to buy right now?
Yeah, well, they come and they qualify and they can afford $300, $400. And so finding, okay, we have a family of 5. Are we going to live in a 2-bedroom condo? Right. So I think that's the problem, is finding the home in the price range to use the funds.
So to have to access the funds, you have to meet a certain income requirement, but you can't have too much.
Right.
And you have to fit certain debt to income ratios
which are stricter
on the loan side. Mm-hmm. So yeah, it really narrows the field on what you're actually able to buy. And then if you take into account that a family of 5 may not want to move into a 1 or 2 bedroom condo.
Right.
That limits the choices further.
Mm-hmm. I think I only did 1 this year. And strangely, most of the ones I do are single people.
Oh.
Which is weird, right?
Yeah.
That are just barely making it, but they can live in a 1-bedroom or a studio condo, It's in their price range and they're at the top of the income limits for the program. So it works for them. So that's kind of like the only people that take advantage of the programs.
Interesting. So on those types of things, say if somebody wanted to get into a property, they use the down payment assistance programs. Mm-hmm. What does that look like if they, at one point in the future, they wanted to turn that into a rental property?
No, no. Owner occupied. If the city or the county, whichever municipality you use, they will make it due and payable. You cannot turn it into a rental property.
Is it like a silent second, or is it just like a small interest rate kind of second? Or?
So there's a lien on the property. It is a silent second. There is, some of them are shared equity, so there's no interest, and then some of them have interest. But either way, they're not making payments. They're just either accruing the interest or they're going to sell and they're going to pay part of their equity out.
Got it. Okay.
Yeah.
So if they did want to convert, they would have to refi into, I guess.
And they're not going to do that.
And they're probably
they're not going to. And it's funny because some of them will call me and say, you did this loan for me 10 years ago, right?
Yeah. So
I want to do it again. And I'm like, so you're like not a first time home buyer.
Yeah,
and
that's
they
right.
don't really understand that. They're like, really? I can't get the money again? You're like, no.
So then that brings up first time home buyer. Define first time home buyer.
You haven't owned a home in the last 3 years.
In the last 3 years, you have not owned a home.
Yeah, and they verify it either by your credit, like if there's mortgages on your credit,
Sure.
or your tax returns to see if you have any interest deduction.
Oh, I see.
Yeah.
Okay.
Owned a home, whether it's an investment property, a vacation home, whatever. If it shows up on your tax returns, you're not a first-time home buyer.
Okay. So that would be an issue for trying to get first-time home buyer programs again.
Yeah, unless, you sold and you waited the time or whatever.
Sure. That makes sense. So then what would be, if somebody bought with FHA or VA, owner occupied, is there any issues with them converting that type of property into a rental?
No, you have to occupy for a year.
That's
what the deed and the notes say, that you're gonna occupy within 60 days and you're gonna be there for a year. After that, you could turn it into a rental. Absolutely.
Okay. Perfect.
It gets a little tricky though when you go to buy another property, FHA or VA. Then it gets a little tricky because it's an owner occupied loan. So, you can't. Well, with VA they have rules about how much eligibility you have if you own multiple properties.
Yes.
Yeah, so it gets tricky. And then with FHA, if you're going to keep your property and turn it into a rental and you're going to buy another property, you have to move 100 miles away to use the FHA again.
Oh, so you're going to be looking at a different loan product then.
Yeah, like maybe if you were going to keep your home in San Diego and you're moving to Orange County, LA or something, absolutely works. But if you're not, if you're like, well, I'm going to move down the street, you're not going to buy FHA again.
Got it.
So there are strict restrictions.
Interesting.
Yeah.
Good to know. Are there any HELOC options for non-owner occupied?
There are. They're what we call like subprime lending. They're going to be banks with very high interest rates. They're not going to go maximum loan to value, but they're available. We have them. Yeah, we don't do them too often. But
is it like hard money rates or?
No, not hard money rates, but I'm going to say probably. Because we're doing a lot of HELOCs right now in the 7s and 8s. I mean, that seems to be the 7s and 8s. So I'm going to say probably the last one we did was like 10.5. It's not too terrible, but you're only at like 60% loan to value.
Oh, so you can only leverage so much of that equity.
Right.
Okay. Now, one thing I've really appreciated, I've known you for a number of years now.
Yeah.
One thing I've really appreciated is you're a no nonsense. You've been in the industry a while.
Yep.
So you're not there to waste anybody's time. You're there to give them the facts and kind of just let them know what the reality of their situation is.
Yeah. I'm very honest.
You don't have time to waste. You want to, you want to help as many people as you can.
Yeah.
Have you had any good client success stories over the last few years?
I will say, even with what you just said, yes, when I meet someone, we'll go through the qualification and maybe they don't qualify. That doesn't mean that I'm not going to give them, a good plan, like, get some more credit established. Or you said, you're going to be finishing school and then once you get out, your income's going to be $100,000 a year more. Like, let's have a plan for the future. So I would say probably just those people coming back, keeping in touch with them and they're working on what they're supposed to do. Maybe it's cleaning up their credit, whatever it is, so that in a year or two they can buy. So I've done quite a few of those actually. So
excellent.
So that's good. That makes me feel good that they're listening.
Yeah, for sure. Yeah.
They can't buy right now and the realtor's just got to slow down.
Do you find that people are getting pushed a lot by realtors or maybe even just family and friends to maybe get into certain properties or areas or neighborhoods that it might not be the best financial options? I
have a past client that I love and did a condo for them and did a home purchase. Their mortgage payment's like $2,700 a month, right? Okay. It's like nothing. They have a really low rate. So they both went to college. They're both like professors now. They're making a lot more money. And so they want to buy a new house. So they're looking at houses with mortgage payments like $8,000 or $9,000 a month, right? And it's like, oh, wait, slow down, right? Is this really what you guys want to do?
Sure.
So you got to take your time. But you tell the real estate agent that, and they're like, oh.
They don't want to talk to you.
We're going and looking at those $1.5 million houses right now, right?
Yeah.
And, not really like taking the time and doing what they're supposed to do and slow down. So.
Got it.
Got to be careful.
So you tend to take a more consultative approach in that you're not there to try to push them into product. You're there to give them the information, facts, make sure they make a good decision, Something along those lines?
Yeah, I mean, like you were talking about when we were doing those neg arm loans in 2007, 8, 9, and you tried to explain them and people didn't understand them. They were hard to understand. And how many people lost their home? 70% of the United States. It was a lot, right? So they need to really like budget and understand what they're doing. But the real estate agents get them all excited. And what do? They take them to like the dream home.
Sure, yeah.
They don't take them to the home that they can afford.
Yeah.
And, you know, they like to buy on emotion, right? You know, I like that house with the brand new quartz countertops. I don't want that one with tile. You know?
Yeah, exactly.
Yeah.
Yeah. Half the size and all
understand.
Yeah.
So yeah, no, I think it is important that they're educated and they understand what they're doing. And I'm clear and like that. I'm not going to get them in and screw around with them. Buy downs. We haven't talked about buy downs.
Oh, talk to me about buy downs.
Oh, buy downs.
What is a buy down? First of all, just in case people aren't familiar with
so
that.
there's you can buy down the interest rate as far as like, let's say the base rate is 6% and you have the money and you can pay some points and get 5 3/4 or 5.5, and you have that rate for 30 years. That's a standard buy down. But for a while, agents were pushing those 3-2-1 buy downs, 2-1 buy downs, where you're basically getting a lower interest rate the first couple years because the seller is prepaying the interest on the note.
Sure.
Okay, right? So let's say your note rate is 6.5. So maybe you're 4.5 the first year, 5.5 the second year, and then you go to 6.5 for the remaining 28 years.
Yeah.
All it is that is happening is the seller is paying the interest up front to get you that lower rate. But the people don't understand that they're not going to be in that 4.5 rate. You explain it to them. This is what's going to happen. That's what's going to, they really don't get it. They really think that that's okay. After the first year, I'm just going to refinance and I'm going to get 4.5 again. Well, we don't have 4.5. So I did one for somebody. They were adamant about this loan. The agent pushed it and it was actually really good. It was 3.5, 4.5, 5.5, which is even like lower than
That's pretty good. Yeah,
it was a great loan. After the first year, she's like, oh, we can't afford that 4.5 payment. We got to refi. I'm like, but we don't have that interest rate.
There is no.
Yeah. So if somebody's going to give you $20,000 to do the buy down, take $20,000 and go from 6 to, I don't know, 5 1/4 or something. Lock in a lower interest rate. Because if you're going to stay there over the term, you're going to save a lot of money, right? Over there.
Sure. Yeah.
If you look at the math, let's do the math on it, which I love math. So let's do the math as opposed to this like instant gratification, low payment. But you really, even though you qualify for that higher payment, you don't want that higher payment.
It may not fit the lifestyle.
So that client that did that loan, they sold their condo. Okay, at the top of the market, got good money, bought this house, did the buy down, lasted 1 year, freaked out, sold their house for exactly what they bought it for, turned around and bought a condo in the same complex that they sold in. Their original condo they paid like $450 for. The one they went back and bought for like $850.
Oh,
like talk about like what a nightmare.
Yeah. Plus they lost all that equity in their buying and selling expenses.
Oh yeah, and the fees for the loans.
Yeah.
And the fees they paid the real estate agents.
Yeah.
I mean, yeah, what a clusterous mess.
That is terrible.
So yeah, I mean, I think that I don't think it is the best option. I think if you're going to maybe live somewhere for 2 years, right?
Sure.
You know, military, whatever, you're going to be there for a few years and you're going to leave. So you kind of.
And you're going to sell.
Yeah.
Yeah.
Yeah. You're going to sell, right? You're going to get out of there. I don't think that you should gamble on this is what's going to happen in the future because, you know, yes, we hope interest rates are going to go down in 26, but what if they don't go down in 26, right?
Yeah.
Yeah.
Yeah. You never know.
Yeah. Plan for today.
Yeah, that's right.
But I do get a lot of that. I do get those calls. Well, my realtor said that, you know, I can refi in a year. Sure, you can.
Got it.
At whatever those rates are.
So if somebody wants to reach out to you, Cristen, get some information, they want to talk to you about maybe loan products that are available for them in their situations, what's the best way for them to get a hold of you?
My phone is always the best way to get a hold of me. I've had the same phone for 40 years. 619-993-9623. You can look me up online. Cristen Carver, Barrett Financial. I have a website.
Your website and everything. You're legit.
I'm everywhere. Put my name in. You'll see a lot of stuff.
Oh, all right.
That sounds funny.
Well, I appreciate you being on today. And hopefully everybody's had a good time listening, got some good information. Make sure you hit like, hit subscribe, check out our other videos, check out our other episodes. Get smarter, be smarter, and we will catch you on the next one.
Thank you so much.
Thank you.